Welcome back, everyone. This week we're going to talk about Dividends Matter Too. And a quick preamble, what led to this publication is at the end of the year in 2023, I saw a lot of people talking about what the S&P 500 returned, and many were quoting the S&P 500 without factoring in the dividends. And I just thought that was absolutely absurd. So I want to dive into that topic today. And if you're interested in reading this or following my other work, in the description below, there will be a link to this article and browse as you wish. So let's get into this. Dividends matter too. To consider or not to consider dividends, that can't be a serious question. I find it both odd and suspicious that dividends oftentimes aren't considered when quoting the S&P 500 index returns. It seems obvious to me that dividends should be incorporated as a baseline, default, de facto supposition when considering returns. The case of the missing dividend. Indices are predominantly measured one of two ways: total returns or price returns. Keeping in mind that, put differently, that's to say that you have total returns and non-total returns. Who in their right mind is measuring an index called non-total returns? WTF? Seriously? I bet you're not. Unless you're backing out the dividends received which contributed to your overall portfolio performance, and I surely doubt that you're doing that. Looking through my Twitter feed during the first few weeks of the new year, I was alarmed. The vast majority, and I'm talking 90+% of people, claim that the S&P 500 returned roughly 24.2% in 2023, which is to say that they're referencing non-total returns, also known as price returns. One dividend investor, this is crazy, one dividend investor even said that his portfolio was in line with the S&P 500 because they both returned roughly 24%. Even a damn dividend investor is backing out the dividends for the S&P 500. Wow. Just wow. It's as though no one knows why they're referencing the S&P 500 in the first place. The reason that the S&P 500 is being used as a common benchmark is because it's presumed that the S&P 100 is the de facto investment vehicle if you weren't invested in whatever active portfolio you're currently invested in. The S&P 500 is the counterfactual alternative you could have invested in. It's commonly accepted to be a brainless decision, and you're trying to reveal the performance difference as to why it's worth the investor's time and money to invest with you, or why it's worth your time to actively manage your own account. It would go to reason then that dividends would contribute to that alternative return, would it not? Thus, not factoring in dividends is just plain wrong. I've mentioned numerous times in my writings how bias and pathology knows no bounds. This insistent desire by people to oversimplify the world strikes here too. You can think of total returns as comprehensive or complex returns, and price returns, the non-dividend version, as simplified returns. It's under that lighting that it makes more sense as to why people quote the price returns, aka the simple returns, aka the non-dividend returns. People are lazy. It goes to reason that you could include the dividends in your reporting. It goes to reason that you would include the dividends in your reporting of your performance. I have never heard or seen an investor not factor in the dividends to their own portfolio performance. Never, not once. But all of a sudden, it becomes okay to do so when measuring an index. That's plain nonsense. Some people might note that a dividend-less reporting style is the standard way of speaking, which it is for, I'm not quite sure why, but it is. But that line of logic is normalizing stupidity. So whoever might say such a thing is using a fallacious appeal to consensus as an excuse for being stupid is stupid in and of itself. Of course, I'm using the word stupid as a placeholder word for many other words, but it helps simplify the idea, and, well, as we've already discussed, people like simple. Some people might say, of course dividends matter, but behaviorally, they don't seem to think so, or they don't act as so. If they believed it, then they would behave like it. My belief is not to concern myself necessarily with what people say, but what they do. I treat behaviors as though they are the real beliefs. Of course, this isn't a scientifically sound argument, but it's a practical and pragmatic mindset. At the end of the day, actions speak louder than words. I would be fine with people reporting the price returns of the S&P 500 and not the total returns if they then didn't turn right around and report their total returns and then compare the two. Talk about intellectually dishonest. Talk about not keeping constant your comparisons and controlling for variables. Talk about misguided, deceptive, and ill-conceived notions. People benchmark the S&P 500 index, but you can't invest in the S&P 500 index. Sure, you can use these swap agreements or other financial derivatives, but most won't. And then you have to ask, which S&P 500 index? This is why you have to also question the concepts in a statement as much as the statement itself, which I've insisted upon numerous times. There's the price return index, and then there's the total return index. So when someone says the S&P 500 index, which one of those sub-indexes or sub-indices are they referencing? If you want to argue with me that it's the same difference and that it doesn't really matter, then I ask you to subscribe to this newsletter, link in the description below, with the proceeds that you received from dividends in your account. Because I do think they matter. And they matter because, well, they in fact matter. But I suspect that the vast majority of you won't buy a subscription to my channel with those dividend proceeds. This is what Annie Duke coined and what I've adopted as the do you want to bet phenomenon that I've talked about before. When it comes time for people to act on what they say, they squirm and backpedal. This is why actions speak louder than words. We've all seen charts like this. You want to tell me that dividends don't matter? Absurd. There was nearly a 2 percentage point spread in the S&P 500 returns in 2023. You know damn good and well that someone is benchmarking that lower number, the price returns, and taking a performance fee out of the 2 percentage point spread. Under a standard 2 and 20 fee structure, a $1 billion fund is taking 20% of that 2% difference. That's an extra $20 million of alleged outperformance. And since that's outperformance, they'll get 20% of that, which is $4 million. So by someone referencing the price index, which excludes dividends, versus the total index returns, they can essentially pocket $4 million in a $1 billion fund. Like I've already noted, nobody backs the dividends out of their portfolio when calculating their returns. But wouldn't that be the fair thing to do if you're going to compare yourself to the price return index, is to back out your dividends? But that presupposes that people care about fairness, as opposed to the pretense and optics of fairness. And this is why you must ultimately decide upon a person's character by their actions. If it's not total returns, what is it? Well, according to market pundits, it's price returns. Total return index equals complete returns. Price return index equals incomplete returns. Who in the hell is benchmarking something called the incomplete return index? And that's why they don't call it that, and they give it a nice little euphemism like price return index. It's all about counterfactuals. You're not comparing yourself to a benchmark for shits and giggles or for funsies. When comparing yourself to a benchmark, you are demonstrating your capacity and recognition that a counterfactual alternative investment exists and that it's worth your consideration. When you compare your portfolio's performance to a benchmark, you are recognizing that there's a counterfactual universe where you could be alternatively invested in that benchmark with the underlying assumption that the benchmark represents a viable alternative that reflects the investment opportunity that you could have pursued instead. And you're comparing your performance to a benchmark that you'd reasonably invest in. That would be the S&P 500. Notice no one uses the OMX Copenhagen 20 as their benchmark here in the United States, which means that your selection of a benchmark is not random. It's a plausible presumption of where you'd alternatively invest the money. The underlying supposition in your comparing your performance to a benchmark is that had you not been invested in a particular portfolio, you would have alternatively been invested elsewhere. It's a consideration of the counterfactuals that's implicitly embedded in the overt comparing and contrasting of varying performances of varying portfolios and indices. Now you might have noticed I said compare and contrast. I say compare and contrast because those who underperform will say such things as, we had better risk-adjusted returns. So now instead of measuring either price performance or total performance, they're obfuscating through complexity. They're broadening out and abstracting matters to factor in more variables in order to justify their underperformance. It's funny how underperforming inflation is never a risk in their risk-adjusted return models. Right? Because, as I said, on a risk-adjusted basis, which is measured oftentimes by VAR, which is volatility at risk, I'm going off script here, volatility at risk, they're associating risk with volatility, which is an interesting thing in and of itself. And then, like, the loss of purchasing power in which the currency that those stocks are denominated in doesn't really seem to get factored into the risk model, which is quite interesting. When looking at the benchmark, you do so because you're trying to answer the question, what returns would I have received if I was invested in that instead? In the case of today's article, the answer is that you would have experienced roughly a 24% capital appreciation and a 2% in dividend distributions, totaling roughly 26%. Those are the returns. Go ahead, tell the IRS that 2% in dividends don't count. You use a benchmark as a reference point to evaluate the performance of your investments, because ultimately you want to allocate capital to the best investment. The benchmark exists as the consequence of your understanding that it would be a reasonable alternative vehicle to consider investing in. This desire to redefine, bastardize, exclude, and compartmentalize returns is an interesting human reaction function. There's only two reasons to do it, not to create a false dichotomy, but two primary reasons. Either number one, you're new to investing and you don't know any better, and fair enough. Or number two, you're diminishing the returns to make it easier to beat. Similar to how the underperforming asset managers and Mag 7 haters try to remove them from their benchmarks by showing you the RSP equal weighted return index instead. They're creating an artificial construct with some one-off reason that the index is up so much in an attempt to handicap it so they have a fighting chance. To aid in your conceptual understanding, you can think of it along the lines of this metaphor. If you're not taller than another person, you cut off their legs so you are taller. Out with the old, in with the new. Words matter. Total return is an adjective phrase that modifies the noun index. The verb returned indicates the action performed by the total return index. The direct object of the verb is the percentage that the total return index achieved. That's how this breaks down grammatically, and that's the interplay between those words, and each of those words also have their own definitions. However, most people just say the index, as though there's only one index. There isn't. That's the problem. One phrase is describing two variations with two different return profiles. How could this happen? Dividends used to matter more than they do now. This chart, link in the description below, so then that way you can click on the link to actually go to the source, as well as other interlinked things in this article. This chart shows how dividends contribute less to one's overall returns than they used to. Dividends and buyback yield from 1871 to 2014, and you can see that dividend yields used to provide 5 to 9% returns for a solid century, and then in the past 50 years, 40 years, we'll call it, it's contributed less. Buybacks matter more than dividends in some sense, but that's a topic for another time. I suspect at some point a slow transition started which made dividends less of a contributor to overall stock returns. Simultaneously, the spread between total returns and price returns shrunk. Following suit, more and more people started using them interchangeably via the word index as a consequence of the lack of difference between the returns of those index relative to the difference between those two indices once upon a time. People started undermining the old definition, total returns, while superseding and superimposing their own definition of return, price return. A return is a return, right? Wrong. I've detailed in several publications about the ease and willingness, like a moth to a flame, that people have in adopting corrupt and misleading speech. EBITDA, or in this case, returns, isn't even a thing of notice to these sorts of people, which are the vast majority of people. Although it's vulgar to my ears, most people are deaf to it. You get a couple of generations of desensitized and complicit and complacent useful idiots and true believers who don't know any better and are being introduced to the markets and trying to appease their bosses, who are just speaking the jargon that they were taught without really knowing the difference or caring to know the difference. And what this is classic shifting baseline and creeping normality, which I often speak about. As the old-timers retired and disappeared, there's no longer users of the old language and mere mindless followers of the new language. This is the slow and creeping transition from why people talked predominantly about total returns to now predominantly talking about price returns. Out with the old and in with the new. Meaning from a social enforcement standpoint, and thus an incentive standpoint, all the reasons to not use the newly adopted language disappears. The crazy part of all of this is that people will adamantly defend their language and how they speak. They have a sort of Stockholm Syndrome complex. The zeitgeist has captured them through an unfortunate turn of events, and now these people readily stand by to defend the words they use, although they're clueless as to why they're saying what they're saying. Why reference EBITDA instead of cash flow, for example? They don't reflect on that question with considerate introspection. All they know is that they're a smart and well-intended human being, and that anything they do comes from a good place, and that that's what their boss wants, and they do what they're told. Talk about a thought-terminating cliche. Yes, they're also delusional. As the quote goes, it's easier to fool people than to convince them that they've been fooled. Because then that would mean that they're a fool, at least in part, and that would affront their own identity and narrative that they tell themselves. And who wants that when you can turn a blind eye and disarm your cognitive dissonance with a little old post hoc rationalization? And let's not forget that there are two sides to this coin. Those who use it and those who facilitate it. They're largely overlapping, but not entirely. Although you, the reader, might not use this sort of language, do you address it in its form when it's used on you? Meaning, do you entertain and use their language? If so, you're an enabler. If a guy says he's a girl, do you call him a she? If a guy speaks of EBITDA, do you entertain that idea or do you push back on it with more meaningful metrics? Do you speak the language of truth and what matters, or do you speak the language of narcissistic flattery and less than relevant performance metrics? How might this change of language look? Well, I'm glad you asked. Some CEO or CFO or some C-suite tries out a new term, phrase, or wording. Sometimes people object, sometimes people are neutral about that term, and other times people adopt it. So who might adopt it? Think of the guy asking a softball question to a CEO on a conference call. That same guy produces sell-side analysis and is giving softball questions to make the company look good. Or they're an investment banker who plans on getting paid by the CEO for underwriting a new share issuance. They'll be more than happy to adopt the language of the CEO. A newer rendition of that might be community adjusted EBITDA, for all you WeWork fans. If the CEO and sycophant analysts are all using quirky metrics, what's the odds that you start using it? If you're an average speculator, you might find yourself talking about TAM, total addressable market, and revenue growth. It's worth asking yourself, why? Why are you using those metrics? As well as, why aren't you talking about other metrics, such as the collapsing margins, general and administrative bloat, and stock-based compensation destroying any hopes of increasing earnings per share? In which I get met with, but the stock is going up. Well, I'll let Ron White fill you in on my thoughts in regards to such a counter-argument. Just remember, you can't fix stupid. Another problem of humans is their laziness in speech. It's just too much to ask for people to add an additional word to a sentence. And I'm not joking, and I'm not being, well, I am being somewhat snide about that, but that is the praxeological description of what is. And it rubs me the wrong way. For instance, the word total or the word price are adjectives that modify the noun. A one-word difference can make a $20 million difference to a $1 billion fund, as I outlined earlier. It's the difference between the above-mentioned dividend investor underperforming versus outperforming. Dividends paid out by the S&P 500 is to the tune of tens of billions of dollars. So the difference between including or excluding an adjective, i.e. total or price, is the difference between someone being able to make an additional $4 million, is the difference of where did tens of billions of dollars from these S&P 500 companies go? Well, you would say dividends, but where does that show up? Because it's not showing up in the S&P 500 index that you're using. But I digress. Returns once meant total returns, and over time it came to mean price returns. The words stayed the same, but the definition changed. What a beautiful convoluted mess that practically no one has ever given any conscious consideration towards, yet has willfully participated in nonetheless. And yet people think that they're in control of themselves. People might try to marginalize and disqualify me by saying, yeah, well, it's only a small difference. As much as I appreciate distractive frame-shifting techniques, they'll have to do better. Of course, those sorts of statements miss the point entirely. The point is being intellectually honest and keeping constant your comparisons and controlling for variables. Another point is that small differences can make large differences. So yet again, let me show you this image. Now you might counter this image, going off script here, by saying, well, that's reinvested dividends. Well, I agree, but don't you need the dividends in the first place to reinvest them? And since we're quoting price returns, then dividend contributions are a small difference and don't really matter. But then you realize that actually the contribution of a dividend in any one instance is a small difference. And then I'm going to show another chart in a moment, but then you realize that over a larger time frame, maybe 1, 3, 5 years, that it starts making a larger and larger difference. And then you realize that if you then use those dividends and reinvest them, then it starts making massive differences. So yet again, small differences can create massive differences. How about you tell the IRS when you don't pay your taxes on that small difference? Or how about when you short a stock that has a dividend and the broker wants you to pay up for that dividend, you tell them not to worry about it because it's a small amount? How about the fact that in total the S&P companies pay out tens of billions of dollars in dividends? Does tens of billions not matter? Because remember, dividends are paid out of retained earnings. And that's money that could have alternatively been invested elsewhere. whether that be share buybacks, whether that be sustaining CapEx, whether that be growth CapEx, whether that be M&A, whatever it may be, like we're talking tens of billions of dollars a year in collectively. So is that small? Here's a simple question that I ask myself. Cup of Coffee Capital, which is me, is all about the following question. Can I beat the market? What I'm trying to do is compare my performance against an alternative counterfactual universe in which I would only invest in the SPY because that's what would alternatively happen if I weren't actively managing this account. And part of those alternative counterfactual returns would occur via a dividend, right? So why leave out the dividend? I want to touch upon this dividend included total returns versus dividends not included, price returns, S&P 500 benchmarking phenomenon to elucidate my point. Imagine if you bought a stock for $100. At the end of the year, it's still trading at $100, but in the meantime, it paid a 20% dividend. Let me ask you this, how much money did you make? You bought something for $100, 1 year later, it's $100, it paid a 20% dividend. That year, how much money did you make? Well, if you're the vast majority of people, quoting the S&P 500 price index, meaning that you're in the price return camp of people, then you'll tell me that I made nothing. And I find that to be, well, as nicely put as I can, an absolutely absurd statement. It's in this simple thought experiment. Oh, what's that? It's not a thought experiment? Oh, look at this, PBR. Interesting. Maybe take a look at this picture. I guess that wasn't just a thought experiment, but a real experiment. And seemingly over a 5-year time frame, the stock price return only increased 5.67%. And yet the dividend contributions allowed you over that same time frame to accrue 138.54% return. So did you make 5% or did you make 138% in this example? Like I was saying, the vast majority of people who feel it okay to cite the price return and don't find it necessary to cite the total return would be perfectly okay with saying that PBR returned only 5.67%. It's in this simple example that you see how foolish it is to exclude dividends. Accuracy comes both in the form of magnitude but also factual representation. In the instance of PBR, you'd say it's inaccurate because of the massive difference between total returns and price returns. That's what makes it obvious to you. But the infraction of intellectual honesty and violation of proper decision-making principles is what makes it obvious to me. We're not the same. Dividends make a small contribution oftentimes, but small contributions matter on a larger timeline. In the same time frame as the PBR example mentioned above, the dividends included S&P 500 returns were 15% more than non-dividend returns. That's a whole year's worth of historical average returns, because they say that the S&P 500, depending on which number you want to quote, returns on average 8 to 10% a year. And over the last 5 years, the S&P price return has returned 80.09%. But if you add in the dividends, then you've returned 95.42%. That's a 15% difference. And if the S&P 500 returns on average 8 to 10%, then that's a year and a half's worth of outperformance if you wish to measure it in that fashion, just to elucidate the point that I'm trying to drive home. In general, this is how people go about life. They criticize others to diminish themselves, to arbitrarily make themselves look better via the mechanism of relative contrasting. Is it any wonder that people also bring that attitude to the markets? They also turn a blind eye to things and sweep them under the rug until they become too big to ignore. The underlying ideas expressed in the phrase, "an ounce of prevention is worth a pound of cure," is a thing people talk about primarily, but rarely act on. Like I've said, people's coping fallacy knows no bounds. It only gets worse from here. Take the following example. And this is actually really cool. This might be my favorite section. It only gets worse from here. Take the following example. Benchmark starts with $100 and ends with $120. So it's up 20% or $20. Person A, comparing themselves to that benchmark, keep in mind, they also start with $100 and they end with $125. They're up 25% or $25. How much did person A outperform the benchmark? This is where you must question the concept in a statement as much as a statement itself. The word outperform begs the question as to what they mean by perform. How are they measuring performance? Now, a lot of people want to roll their eyes and dismiss it and balk at what I'm saying. Like, it's obvious. Yeah, that's the problem with the word obvious, is that just causes you to let your guard down. And I'm going to show you a real life example of a very large, publicly traded, I believe, medical company that is going to take advantage of you wanting to dismiss questioning the concepts in a statement as much as the statement itself. But just in a moment. So, number one, I try to word this the best I can, but it can be a little confusing, but just follow along if you can. In absolute nominal dollar terms, person A outperformed the benchmark by $5. In absolute percentage terms, person A outperformed the benchmark by 5%. Okay, that's how most people would say how person A outperformed the benchmark. They both use the starting reference point of $100 to measure the difference. But check this out. But in relative percentage return terms, person A outperformed the benchmark by 25%, because $25 is 25% more than $20. The first and second way are the most common ways of speaking in regards to one's performance. However, the grifters and disingenuous types will speak to the third way. Why? Because they know that you're desensitized and complacent in examining matters and will take them for their word. I've seen this sort of thing happen firsthand. This isn't a theoretical what if, but a reality of the world we live in. Check this chart out. This is awesome. This sort of obfuscating doublespeak is fascinating, and I would encourage anyone to watch this video. So this is why you need to click on a link in the description and scroll down and watch this video. It's a worthwhile 16-minute investment. Since I often listen to things in a 1.5 times speed, that makes it a 12-minute video. Trust me, it's worth seeing the games people play and wisening up to it. If you breeze by the first link, here it is again. Here's a juicy screenshot. Look at those two far left bars. Did you know that's a 36% difference? LOL. But Lipitor was dead serious about making this claim. Look at that. Oh boy. This is a beautiful, beautiful image. And really, you must watch that video. Or at least fast forward through the video, scrolling till you see this image, and then watch these couple of minutes. I should have time stamped it, but I didn't, so I apologize. But this is beautiful, beautiful difference. The takeaway from this is that things can be measured in various ways depending upon the preference of the measurer. This is why certain people say they're up $50,000 on their account. And I'm speaking in particular to certain YouTube channels. It's a big number to the average audience member and thus has a wow factor. However, if they have a $2 million account, they're up only 2.5%, which doesn't sound nearly as impressive. But when you're in the business of clicks and likes, you end up portraying matters in more of a sensational relative fashion than a more honest manner. This is why hashtag follow the science and hashtag numbers don't lie are just plain silly. People sandbag. That's just what they do. People sandbag anything and everything that they're competitively up against, whether that's people on the dating market, work environment, or investing benchmarks. It's because they lack the necessary merit that would warrant them getting what they want. And if you can't or won't make yourself better, your best option is to make others look worse. I talked about that earlier when I said, if you can't be taller, then your best bet is to cut off someone else's legs. Sandbagging. I've touched upon this sandbagging mechanism via my Mag 7 articles, yet Mag 7 is merely an example and case in point of basic human tendencies and patterns of behavior. And if you're interested, you can read them here, here, and here. Link in the description below. People selectively exclude strong performing stocks out of the benchmark to artificially and arbitrarily lower the benchmark's overall performance. They try to alter the composition of the index in a more flattering light. They'll use different calculating methodology that isn't standard in an attempt to make themselves look better. That's the relative comparison with the whole Lipitor example I just provided you. I demonstrated this in the relative percentage return example. Another avenue of sandbagging is to inconsistently compare two things: your dividend included portfolio versus the dividend excluded benchmark. In conclusion, everything I cover today is tangentially associated but not mutually exclusive to the financial realm. People's tendency is to manipulate perceptions in a fashion that suits their agendas and maintains a flattering narrative. This publication is yet another example as to why it's crucial for you to keep constant your comparisons, control for variables, consider counterfactuals, and question the concepts in a statement as much as the statement itself. This article is yet another example of those core tenets and principles that I drone on and on about. The lesson here is simple. Include the dividends. Cup of Coffee Capital is a reader-supported publication. To receive new posts and support my work, consider becoming a free or paid subscriber. Thank you for watching, and that'll end it today. Until next time.